This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everybody. Yes, indeed, it is Thursday, March 19th, 2026, across Bloomberg platforms. I'm Carol Massar, along with Tim Stenovec, live here on Bloomberg Businessweek Daily. You have got stocks under pressure again. U.S. yields continuing to move up. We've kind of seen this trade actually globally when it comes to the bond trade. And increasingly, we're looking at a war and a military spend without an end in sight. Just check out the U.S. war in Iran update. We got that earlier this morning with U.S. Defense Secretary Pete Hegseth.
I'm jumping in, Carol, because we got a redhead crossing the Bloomberg terminal. NASA revising its moon landing plans, reducing Boeing's role while elevating SpaceX's Starship rocket to do the job of propelling astronauts to lunar orbit. This is according to people familiar with the matter. I'm taking a look at what's going on with Boeing shares as we speak. They're down about 3% right now. They've been down throughout the day today, but this just another hit for Boeing.
All right, so that is something we're watching. Really, though, our focus over the next 60 minutes is about the war, the military spend, and as we mentioned, the Defense Secretary weighing in on that this morning.
As far as $200 billion, I think that number could move, obviously. It takes money to kill bad guys. So we're going back to Congress and our folks there to ensure that we're properly funded for what's been done, for what we may have to do in the future, ensure that our ammunition everything's refilled, and not just refilled, but above and beyond.
All right, that, of course, was Defense Secretary Pete Hegseth this morning with a briefing on the U.S. war in Iran. So no doubt about it, the war is definitely top of mind. So coming up in the next 60 minutes, we're going to get into the billions being spent. We're going to talk with Sheila Kahyaoglu. She is over at Jefferies. She covers the defense sector. We've talked about it a lot with her. So we're going to have her kind of crunch the numbers. She's also been in D.C. this past week talking with the Defense Department, the Pentagon, officials there. There's been an event going on. So I'm curious what she's hearing, certainly from officials.
Looking forward to that conversation. Also, how the weeks of war are reshaping the global gas market for years to come. We're talking a lot about oil, but nat gas, the moves higher in nat gas that we've seen in such a short time, those are moving higher so much, Carol. Certainly top of mind for us and also for Europeans.
And then we're going to kind of tie it all together. The military spend, the higher energy prices, inflation. What does it mean for global economies and global markets? We're going to do that with the head of fixed income strategy for Merrill and Bank of America Private Bank. He's sitting down with us. We're going to get to him in just a moment. First up, though, let's get to the trade. We've got a couple of hours to go. Here is Charlie Coward.
Hi, thank you very much, Carol and Tim. Yes, the Dow, the S&P, NASDAQ, all in the red. Do want to repeat the headline Tim brought us just a few moments ago. Boeing shares down 3% right now. Boeing leading the Dow Jones Industrial Average lower. This as NASA said to be revising its moon landing plans, reducing Boeing's role while elevating SpaceX's Starship rocket to do the job of sending astronauts to lunar orbit. Again, Boeing shares down right now by 3%. Dow Industrials down 392 as energy rises. The Dow down 0.8%. S&P 500 index down 46 points now, down 0.7%. We're off session lows. NASDAQ down 187, down 0.8%. The VIX just above 25 now, a day after the Fed announcement. 10-year 4.27%, the 2-year 3.85%. Gold at $46.06 the ounce, down 4.4%. And again, WTI, West Texas Intermediate crude now flat on the day at $96.33 a barrel. Brent, the global benchmark, 108.37, up now by about 0.9%. Price of oil and nat gas jumping as escalating attacks in the Persian Gulf threatens long-term damage to major energy facilities. Indeed, a topic we'll be exploring right here on Bloomberg Businessweek Daily. And by the way, 20% of the world's natural LNG, liquefied natural gas, comes out of the Gulf. European nat gas right now up 13.1%. Again, West Texas Intermediate crude now little changed, up under 0.1%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, got it, Charlie. All right, well, each week, the world's largest liquefied natural gas plant remains shut. The world loses the equivalent of enough energy to power Sydney's homes for an entire year. Qatar's Ras Laffan plant closing earlier this month. You know that. We've talked about it. After an Iranian drone attack, the first interruption to supply in 3 decades of operation. Now, after further hits in retaliation for an Israeli strike on the vast South Paris fields that happened yesterday, the wider complex has suffered, Tim, what Qatar describes as extensive damage.
With more on how weeks of war are reshaping the global gas market for years to come, we head to the Bloomberg News Washington, D.C. bureau. And to our reporter who covers the LNG market, Ruth Liao, joins us. Ruth, want to talk a little about the infrastructure in the Middle East and the idea that this could shape the global gas market for years to come. At this point, what has been taken out when it comes to natural gas?
So this has been a significant development for this ongoing crisis. The latest attacks, as far as we know, have struck the liquefaction facility at Ras Laffan, which is the largest on the globe, and really massive equipment that could take much time to rebuild, and that's only presuming that there would be a let up in the conflict. So having all of that uncertainty has really disrupted global markets with end users in Asia and Europe looking at elevated gas prices for time to come.
Well, and so I'm glad you went there in terms of what Asia and Europe is watching, because we do talk about distinctions between who is being so served by the region. President Trump saying earlier today, we don't use the Strait of Hormuz, and so the U.S. isn't really impacted. Is he completely correct on this? And then there's the reminder that markets are global, so what happens around the world often does happen to possibly impact everybody.
Yeah, the U.S. has become the largest LNG exporter globally, overtaking Qatar in terms of production. But this is such a massive supply shock that even with all of the LNG facilities in the U.S. running as much as they can, it's not going to be enough to backfill that deficit. So the impacts that we'll see will have immediate consequences for end users, Southeast Asia, the ones that are looking and using this LNG for industrial and heating purposes, for power utilities. Will there be changes in demand? This is what experts are expecting will happen because, again, this has been such a sudden supply shock.
Ruth, what about Europe? And I think back to the beginning of Russia's invasion of Ukraine and the supply shock that we saw then. And certainly it was in a different time of year when it was set to be cooler than it is set to be in the months moving forward. And that was a big supply shock and really affected Europe's economy. What about the effect on Europe with this shock?
Yeah, the distinction, I think, with the invasion of Ukraine is that it was mostly pipeline gas that was dramatically reduced by Europe, and LNG was there to backfill for that lost supply. The U.S. stepped up to provide a lot of the LNG cargoes then, and then we saw a redirection of flows. This time around, as you mentioned, storage will be on top of mind for the next few months as storage needs to rebuild. But really, if there was a time for this to occur, it's during what traders call the shoulder season, relatively lower in demand before there's the high cooling season for the summer in the Northern Hemisphere, and before there's going to be winter demand as well.
Hey, Ruth, one more question before we wrap up here. The story that you got out on the terminal, you and the team, it's headline, Weeks of War Reshaping Global Gas Market for Years to Come. I mean, this is, where we're trying to get to, the timeline of this war and when we can kind of start to not think about the energy shock. But is this something that is going to last and impact these markets for a while, especially maybe it is for the European and Asian markets?
Given the uncertainty in terms of the extent of damage, not knowing how long it would take to repair, as I mentioned, this is massive infrastructure, not just in scale, but in terms of the type of technology that's used. It really is clear that I think those will have an enduring impact. It's not even just a matter of, clearing the Strait of Hormuz and allowing for the traffic to flow again, but really being able to have the labor, the equipment, the repairs, the workforce, et cetera. All of that still needs to be laid out. And could take a significant amount of time.
Yeah, it maybe makes sense too why you're seeing some of the energy equipment companies, the drillers, they're really rallying in today's session because you do think about what kind of demand will be for them in the future. Ruth, thank you so much. Really appreciate it. Ruth Liao joining us. She is Bloomberg News Washington DC bureau. She's there, and she of course covers the LNG market for us here at Bloomberg.
Well, global energy markets affecting global markets overall. It played out too in global bond markets as bonds tumbled worldwide. Investors rushing to bet on higher rates after key central banks signaled fresh concern that the surge in oil prices will deliver an inflation shock. Carol, 3 weeks into the war, the fallout unleashed a major repricing across markets by dashing once widespread expectations that central banks would cut rates this year to spur growth. It's having big implications.
Yeah, I mean, I feel like we are thinking and talking about the fixed income world a lot right now. With us to do that even more is Matthew Diczok. He is Managing Director, Head of Fixed Income Strategy for the Chief Investment Office within Bank of America, also helping drive investment thinking, supporting B of A, Private Bank, and Merrill. He joins us here in studio. How are you?
Doing great. Thanks for having me.
Doing okay, and good to have you here. Global rates. The global bond sell-off. We kind of understand what's going on here, but are we entering, Matt, in your view, a new era when it comes to the global bond trade?
We're not overly concerned about it, particularly from a U.S. perspective, right? If you think about it, what Japan is going through now with the BOJ being a little bit behind the curve, catching inflation, we've been through that. We got through that 5 years ago. The best way to look at it's real yields, right? Inflation-adjusted yields. Not exactly, but approaching 2% on 10s, approaching 2.75, getting close to 3 on 30s. That looks great relative to the rest of the globe, right? Rest of the globe, you got Germany probably 75 basis points on 10s. You got Japan 35 to 50 basis points. Our real yields look quite attractive here. So if there is more of a sell-off, expect it more sort of in the developed markets around the world, not as much in the U.S. We've already adjusted to higher inflation. Now, I'm not saying there's not more upside here.
All of it? Like how do you factor in the war? Are you we've been trying to assess what we got from Fed Chair Jay Powell yesterday about kind of looking through the energy shock, but time will tell, right? Whether or not this is a longer problem.
But time will definitely tell whether this is more of a problem. And you can look at it sort of either way, right? We were joking before. You could look at it that, energy prices are inflationary. All the spending on AI CapEx is inflationary.
Right.
We haven't hit the PCE target in 5 years. Can't hike rates, right? You got to hold them steady. Or you can look at it a different way. You could say, actually, productivity is going to come through and it's going to lead to higher growth. You saw that in the S&P. They ticked up a little bit in terms of their expectation for growth. You can say, actually, AI is going to be slightly disinflationary. And you can say, gasoline prices, energy prices up over the short term, much like we talked about tariffs last year, doesn't necessarily lead to economy-wide inflation. It's inflationary pressure, but you need spending on everything else at the same level and those higher prices to generate it. So we're not overly concerned about long-term inflation from a near-term spike in energy prices.
Which of those two views do you think is right?
It's a Rorschach test. You'll learn.
I mean, those are two totally
right.
Yeah, and look, it's
you're going to learn more about me from that answer than you're going to learn about what's going to happen in the economy.
Sounds like a man trained in the liberal arts, but truly, I mean, which one is more likely?
That's a tough place to be, too.
So I'm being flippant, but I mean this because you can be a policymaker on the FOMC. And you could have a principled view, depending on which mandate you think which is more important. Is it maximum employment or is it price stability? So the question to me is not as much what is the right answer or what is my answer. What is the Fed chairman's view? What does he think?
Which Fed chairman?
Assuming, and by the way, I think Powell obviously is a professional, did a wonderful job yesterday. He is setting up the next Fed chairman, if there is a next Fed chairman near term, he's setting him up to be able to do whatever he wants.
Wait, I think it's even wild that you even said if there's a new Fed chairman.
In the near term, it's possible. Okay. Chair Powell said himself yesterday that he's unlikely to step down if there is not a resolution to the legal challenges. So it's certainly possible, as he said yesterday, that he stays on pro tem. But let's assume we work through this.
At some point.
We work through this, and Kevin Warsh gets appointed and nominated. The real question is, what's his view? His view's been clear. He believes, and we've talked about this at Chief Investment Office, whether it's CIO, Chris Heisey.
Yeah.
This feels a lot like the mid-'90s in a lot of ways. We had a doubling of the Fed funds rate from 3 to 6 in 94. People worried about, the yield curve inverted, a recession's coming. Everyone nervous. Didn't happen. Greenspan correctly pivoted. We had the longest recession at that point in economic history, and tech took us through. It feels very much like that now.
Yeah.
That we've had that bond bear market from the hike in rates. We might get a productivity boom. And folks, let's break it down here, right? This 2% inflation target, it is not based on U.S. financial history. It's got zero, zip, niente, nada.
But it's still a target.
But
it is a target for now. They haven't hit it in 5 years. The average inflation rate in the U.S. and CPI has been calculated is 3.3%. So there's nothing to be overly concerned about, except for the target on a 3% inflation rate. Nominal GDP, the stock market, the economy, corporate profits, spending, income, they all do fine at 3% inflation. So it's really a choice for the Fed to make. And again, as I'll say it again, Powell's a professional and is setting up a new chair to be able to position it how he wants. He's not thumbing the scale in any way.
Well, so how does a new Fed chair, how does a Kevin Warsh as Fed chair want to see things progress? I mean, do you see the rate path differing if this was indeed the second to last meeting that Fed Chair Powell presides over?
Our belief for now is that you're probably going to get another 2 cuts this year, right? We saw how candidate Warsh presented himself. And again, he's giving that story that looks much like the mid-90s, that AI is going to be productivity enhancing and will allow further U.S. economic growth that's slightly disinflationary. That is the 90s parallel. So to your question, Tim, is whether that's right or not, you're not going to learn near term, but that's his view. And so we expect him to at least try and deliver one rate cut before the midterm elections. That's November. So we got June, July, and September to deliver one rate cut, right? So expect one, and then maybe another one before that.
But if everything is so good, Matt, taking out
I didn't say everything was
well, but you sounded like earnings. You talked about a lot of good things that were going good. Why do we need a rate cut?
I said in an inflation environment of 3%, all those things are still fine. I'm not saying the economy right now is fine. The economy right now has issues.
Right.
The slow growth job market is a significant issue that might need a rate cut or two to address. Again, but that's not when do you really worry about an economy? Not when job growth slows, when people started getting fired, right? And we're not seeing that in unemployment claims. We're still ticking around at 200, 250.
Low fire.
So in the again, when people start to lose their jobs or afraid their wife's going to lose their job or their brother, then people retrench. We're not seeing firings, right? We are seeing slow job growth, so it's not necessary for the Fed to move a lot in either direction.
But do people retrench if they think gas is going to be $1 more a gallon than it's been for months?
Absolutely. If it goes up and stays there, but that's not what the oil market's telling us. It's telling us the first month contracts, almost doubled, but not the 12-month.
Yeah,
it's only up $10 to $15.
Yeah,
the market is saying...
He's been obsessed just watching the
right? The market is saying, again, and the market is smarter than me. It's telling you, it doesn't tell you what the resolution is going to be, but it's been pretty clear that this is not going to be, in the market's opinion, not a sustained increase in energy. And again, you would need that sustained increase, and you would need the consumer to spend just as much on everything else to keep inflation-wide problem across the economy. Consumers will only do that if they dip into COVID savings, which they don't have, spend a lot more real income, which they're not getting, borrow against their houses to fund consumption like they did in 06. We're not seeing that. So again, energy is an inflationary pressure, but to create inflation, people need to spend as much on gas and the same on everything else. If gas prices go up, they could retrench. It could create demand destruction for the rest of the economy. Energy prices can in some way act like a rate hike, believe it or not, right?
Yeah, absolutely, right? So, okay, 30 seconds. So what's your advice to investors?
Our advice to investors, again, generally speaking, we're not saying investors have to be tactical. If they want to be strategic and hold a portfolio, not move it, that's fine. If they want it to be tactical, we are positive on the economy. We're very, very positive on the U.S. versus the rest of the world. The more dangerous the rest of the world gets, the unassailable competitive advantages the U.S. has, demographically, geographically, institution-wide, education-wise, we are believers in the U.S. So we're overweight U.S. versus the rest of the world. We're underweight fixed income, not because we don't like fixed income, but just to fund our equity overweight. We're not long or short duration.
Interesting.
We want to be neutral duration right now, but if you're looking for opportunities for high tax rate investors, long munis look quite attractive at the moment.
All right. Great stuff. Come back soon. Really appreciate it.
Thank you, Carol. Thank you, Tim.
Managing Director, Head of Fixed Income Strategy for the Chief Investment Officer over at B of A. When we come back, we're going to talk a little bit more about the war in Iran, and we're going to talk defense companies. That when we return.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. We are now looking at a decline for West Texas Intermediate crude oil, down 0.6% right now at 95.77 a barrel. Brent off session highs 108.13 right now. Barrel of Brent still higher, up by 0.7%. But again, right now, WTI trading lower by 0.6%. Crude 95.77 a barrel. Stocks do remain in the red, with the Dow, the S&P, NASDAQ all retreating. S&P 500 index down 35, a drop there of 0.5%. Dow Industrials down 321, down now by 0.7%. And NASDAQ lower by 132, a drop there of 0.6%. The VIX is now below 25 with a 24 handle. The 10-year, a day after the Fed, 4.27%, with a 2-year, 3.83%. Gold down 4.3%, 46.10 the ounce. And again, WTI, West Texas Intermediate crude, 95.77 a barrel, down 0.6%. Brent up by 0.7% at 108.18. And keeping an eye on European natural gas, up now by 13.1%. Oil and gas prices jumping today as strikes on Gulf facilities escalate. Sources tell Bloomberg NASA is revising its moon landing plans, reducing Boeing's role while elevating SpaceX's Starship rocket to do the job of propelling astronauts to lunar orbit. Boeing leading the Dow Jones Industrial Average lower. Boeing shares right now are trading down by 2.7%. Briefly, Uber planning to invest as much as $1.25 billion in car maker Rivian Automotive to help launch a robo-taxi fleet. Recapping, S&P down 0.6%. The big news, though, the retreat for West Texas Intermediate crude, 95.77 a barrel, down now by 0.6%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Massar, Tim Stenovec, live here on Bloomberg Businessweek Daily. Now, as we heard from the top, or at the top, I should say, U.S. Defense Secretary Pete Hegseth confirming that the Trump White House is asking for an additional $200 billion from Congress to pay for the war against Iran, even as earlier this morning he also argued that the campaign was ahead of schedule and disputed that the U.S. was getting embroiled in a quagmire. President Trump, though, also addressing the military situation earlier today from the Oval Office, specifically talking about stockpiles.
Fortunately, we have a lot. We have a tremendous, unlimited supply of what you'd call middle and upper middle armaments and military equipment, munitions, armaments, but munitions in particular. Raytheon is building 4 factories. Lockheed is building 5 or 6 factories, and they're building them fast. They are now building a tremendous, there's never been anything like it, what's taking place right now. So we're in very good shape, but we want to be in the best shape we've ever been in.
All right. So are we in good shape? We want to ask that of our next guest.
Sheila Kahyaoglu is with us. She's managing director in equity research at Jefferies. She joins us here in the studio. That was President Trump at the White House earlier. He said a lot that we want to unpack with you. Are we in good shape when it comes to munitions?
You were in D.C. this week, right?
We attended a conference called the MacLeese Conference. Jim MacLeese is an expert in bringing folks from the Department of War together, whether it's Army Secretary, Navy, Air Force, and critical weapon systems. And the theme there, very, clearly all appointed by the administration, so there's a view there. $1.5 trillion budget is going to come out from the president's request at the end of April and May. That's kind of new. It's delayed. We thought any day now, but we know it's going to be at the end of April, and they're sticking to their $1.5 trillion. And I don't know how Democrats will align with that. With that, President Trump's comments, I don't know if we're at unlimited stocks of missiles and munitions, but that's one thing that's clear from all the DoD employees, all the Department of War folks, is that missiles is the best part of the market in terms of growth to invest in for investors. And that's why you're seeing 4x production increases. So what the Department of War has done, working with multiple primes like Raytheon, like Lockheed, is to put forward frameworks on missile production, saying over the next 7 years, we'll guarantee you production increases on a PAC-3 missile from 600 units a year to 2,000 units a year, which is a big revenue bump. And we will guarantee that for the next 7 years. So can you build enough capacity to do that?
Can they?
Well, they're working on it, and I think that's a theme that the Department of War, more than anything, could align on, whether it's Republicans or Democrats, is that there isn't unlimited supply, And what we do manufacture from a missile perspective is quite expensive. We're doing it in low quantities, so we have to do it in larger quantities and also find ways of manufacturing cheaper munitions and missiles.
The president's comments about what Raytheon is doing, building 4 factories, Lockheed building 5 or 6 factories, does that align with what these companies have said publicly?
Yeah, we're seeing 30% increases in CapEx for basically 15 to 20% of their revenues. We continue to see 8%, even though we're hold rated, 8% upside in our estimates if Raytheon and Lockheed could actually meet these frameworks. And those are only 3 that have been announced thus far. I think you'll see more to come. There's dozens of offensive and defensive missiles. We put out a missile primer today, and folks were emailing me, well, you missed this one. Well, you missed this one. I was like, well, there's so many opportunities to continue to invest. And I think that's one thing the government will agree on.
I mean, it's a whole supply chain, right? It's the suppliers. I mean, when you look at it, we obviously talk about the big defense companies, whether it's Lockheed Martin, whether it's RTX, but there's a ton of American companies, right, that are going to be impacted by this.
We're trying to find ways that might not be as obvious, that have also really great margins associated with it, and might not have to have the massive capital expenditures without the share repurchases. So like Woodward is a great way to play it. Solid rocket motor providers, even HEICO that does missile components, Elbit in Israel. So there's a whole slew of ways to play missile defense and offensive missiles.
So not just U.S., obviously, global.
And I would say Howmet and Woodward are great ways to play it that traditionally people might not think of.
Can I just ask you, what is the supply chain like for defense companies? Is it a global one?
No, it's mostly in the U.S.
Okay.
It's U.S., but what the government's trying to do is dual source it in the U.S. So having multiple suppliers, because the capacity increases are going to be pretty significant.
So I hear you talking about the opportunity that these primes have ahead of them. Yet as you mentioned, you still have a hold rating on RTX, Northrop Grumman, Lockheed Martin. What would prompt you to change those to buy ratings?
I think the Department of War, one of the things that they've done is has guaranteed the top line, but they haven't guaranteed margins associated with it. On top of that, the primes have to invest their own capital, cut their repurchases in order to invest in the CapEx themselves. So at the end of the day, it doesn't change their EPS algorithm much. It actually, keeps it the same, even though they're investing for the Department of War much more. And that was part of the executive order President Trump put in at the start of this year. He said, I'll give you these frameworks, I'll boost the budget. But we haven't seen margins associated with it. And of course, some visibility as they finally have 5-7-year contracts should be helpful in margins. Then they don't have to renegotiate a contract term every year.
Having said that, we have an administration that when it identifies something as important to national security, they get kind of more aggressively involved, whether it's the semiconductor space, whether it's rare, earths and rare minerals. And I just wonder, is there something more that we would anticipate from the administration, this administration, when it comes to defense companies, whether it's taking a stake, making some further investments? I'm just curious what you are hearing.
I think they'll continue to do that, whether it's providing frameworks, so they'll allocate the dollars so that it'll be big contracts, so the primes will have no choice but to invest. It won't be, kind of wishy-washy, like we're only going up 5. It'll be 600 to 2,000. So the CapEx investment is needed, is critical. There's a 7-year time horizon. So first, we'll see more long-term frameworks.
Right.
Second, I think you could see some stakes. We've seen some of it already.
Yeah.
Of course, these primes don't have infinite capital, and they're already spending a big chunk of their CapEx now associated with missiles. So if there's more and more needed, you could see the government get involved.
Can I just ask too, shift to drones or more drones? I think this war has been fascinating. Well, fascinating is a bad word to use because it is war.
We've seen the way that it's fought different than previous wars.
Yeah. Is there a shift in terms of the kind of weapons that these companies want to be working on or are working on in the future? Or does that kind of get sidelined as a result of these orders from the government?
There's so much going on, right? So with Russia and Ukraine, I think you've seen 70% of the fatalities associated with drones. But that's not the kind of drone warfare the U.S. might use. So we'll need more maneuverability, more electronic warfare with drones. But the key, I think, whether it's missiles, munitions, or drones, is ability to manufacture it today, readiness, and scalability, doing it in the hundreds of thousands, not only 100 or 200 or 2,000 units even, which is what we've seen from at least Russia, Ukraine, Iran, is they manufacture missiles in the thousands, not smaller quantities like we do.
So how are you looking at magazine depth in the context of comments that we heard from the Secretary of Defense earlier today? He said in the Oval Office, missiles being shot down shot are down over 90% since the beginning. One-way attack drones down over 90% since the beginning. The U.S. is going after Iran's industrial base. Does that mean a lot of the munitions that we've used up or have used, those will not be used in the coming weeks or months, depending on how long this goes, just because Iran's capabilities have changed?
I'm not sure how Iran's stockpiles look, but what we're doing is very expensive. I don't know how much the war is costing, but it could be $10 billion a day. So
$200 billion more is what, right?
Yeah. So over the last 18 days, it's very expensive what we're doing. So we have to, a theme is like readiness, scalability, and also affordability. We can't manufacture shoot down objects with $5 million missiles when they have $50,000 missiles. So we have to come up with ways. And that's what's really driven this administration has been super supportive of startups, the defense tech names in the world. It's led by Anduril, that's more publicly known, but there's a whole bunch of names we cover, like Voyager, that are out there trying to take a piece of the pie that was previously not given to them.
Hey, I want to bring in a question from our Wayne Sanders, who we talked to a lot about. He's down in Washington and part of our Bloomberg intelligence team, but he said, which programs are most at risk of funding versus revenue due to execution or industrial bottlenecks?
That's such an interesting question, because I asked Jules Hurst, who's the DoD comptroller, so think of him as the DoD CFO managing about $1.5 trillion. And this week I asked him, what do you think is going to get cut if the Democrats don't approve your $1.5 trillion budget? And he's like, I had a hard time getting to $1.5 trillion. I had to cut to get there. And I was like, the budget today is $1 trillion for context. So 1.5 is a significant increase. So the Republicans are going for full steam increases across everything, essentially. And I think historically what's been thought of as areas that will be reduced is F-35, a fighter of the past, or helicopter spending. And we're seeing that obviously come into the forefront of conflicts like Venezuela and even Iran, right? Where we're using older aircraft, and the need for it, it's kind of reignited that need.
Can you believe we're talking about the F-35 as being something of the past, given how much we spent on it?
For investors, it was something of the past, but it's actually driven a revival in Lockheed stock, which has been leading the primes in terms of performance, as we've seen it used multiple times. So it's had a bit of a rebirth.
Okay.
All right.
Do we have time for a
30
quick question on airlines?
Like, what do we need to know right now?
I think, basically this is a month of COVID for airlines in the Middle East. You're seeing capacity cut 80%. So a lot of work is being done on how does that impact global air traffic, up 5%, Mideast accounts for 10%. How does that hit, number one, global air traffic, global aftermarket demand? And then how does that hit sticker shock for folks buying airline tickets in the U.S. as oil goes to wherever it's going to go?
Yeah, we talked about a lot of travelers buying tickets in advance before this stuff kind of hits.
I've been doing that. So.
Lock the doors. We're not letting her go. We're just going to continue. We're going to, as Tom Keene would say, we're going to rip up the script. You are a gem. Thank you so much.
Thanks.
Sheila Kahyaoglu, she's Managing Director in Equity Research over at Jefferies. Just a must when it comes to defense and airlines. All right, when we come back, we're going to talk about a different battle of sorts. That's next.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. Crude futures in the U.S. have erased earlier gains. Investors are weighing comments from President Trump and Treasury Secretary Scott Bessent. West Texas Intermediate crude now down by 0.2%, 96.13 a barrel. Brent does remain higher. Barrel of Brent crude up 1.6%, 109.08. But bottom line here, WTI lower by about 0.1%, 96.26 a barrel. Earlier today, U.S. crude did spike above $100 a barrel before easing. Brent was above $119. Again, a barrel of Brent right now at 109.18. The Dow, the S&P, and NASDAQ, they're all in the red. S&P down 49 to 65.75, down 0.7%. Dow Industrials down 426, down 0.9%. The NASDAQ Composite Index down 182. For NASDAQ down 0.8%. The 10-year at 4.28%. The VIX, by the way, below 25 now. 2-year yield 3.84%. Gold at $46.05 the ounce, down 4.4%. WTI down 0.1%, 96.26 a barrel. Wall Street lending giants will be getting relaxed capital requirements under proposals unveiled by the Fed today in a move that could potentially unleash billions of dollars for lending. share buybacks, and dividends. Citigroup shares up 0.3%. Bank of America down 0.3%. Wells Fargo down by 0.4%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. So we talk a lot as of late about how something like artificial intelligence is going to be impacting all of us as workers. Yes, perhaps increased productivity, also making tasks and maybe certain jobs obsolete. But another thing that we often talk about is health, wellness, or lack thereof, that it can really matter in terms of how we are as workers and how it impacts us in the work environment.
Yeah, on that, a Mayo Clinic proceeding study, 2023, it found that menopause symptoms cost the U.S. economy approximately $26.6 billion annually, including $1.8 billion in lost work time. The research indicates that 11 to 15% of women experience adverse work outcomes, such as missed work or reduced hours, due to severe symptoms.
All right, so let's get to the Bloomberg Businessweek Women's Health segment. We focus on key issues in developing technologies impacting the present and future of women's health around the world and health really more broadly. With us is Dr. Susan Loeb-Zeitlin. She is Assistant Professor of Clinical Obstetrics and Gynecology at the Weill Cornell Medical College. She's founder and director of the Weill Cornell Women's Midlife Center, and she's joining us here in studio. Welcome, welcome.
Thank you so much.
Tell us, first of all, like we talk often about the disconnect that so many different women's issues don't get studied. Tell us, though, what's going on when it comes to menopause and research in that area.
So definitely not enough research, but the research has sort of gone up and down, and that's really affected menopause care over the years. I can expand on that. Hormone therapy came out in the 1960s, and that was great, but then we saw an increase in endometrial cancer in women using it. That dropped the use. Then we realized you needed to take estrogen with progesterone. Then we got an increase when we realized, okay, that would fix the problem with endometrial cancer. And then over the years, there were studies showing beneficial effects, maybe preventing helping every part of our body from head to toe, but then we saw maybe it wasn't so good. And then in 1998, a randomized controlled study, which you might be familiar with, the Women's Health Initiative, came out. And that was the first a huge randomized study comparing the effects of estrogen and progesterone to nothing. And we saw in the early analysis of the study, it was cut short because it was showing an increased risk of breast cancer, stroke, and heart disease. So the use of hormone therapy plummeted in 2002. I remember where I was when that study came out, and we pulled hormones away from women kicking and screaming. But now that's 20 plus years since then, and we're starting to see an increase again because that study where the data was not so well interpreted and released has now been established that hormone therapy is safe for many women to use.
But not for everybody.
Not for everybody. It has to be very individualized.
And where are some challenges with that right now? Because it seems like everywhere you look, whether it's social media, whether it's a mainstream publication, they are talking about this for treating menopause or even perimenopause. What's the right balance here?
So social media has been amazing because it's really gotten the word out about menopause care, right? So that's fantastic. But there's a lot of information that's being delivered on social media that's not based on evidence. There are some people that say everybody should be taking hormone therapy, but really the care of menopause women is so individualized. What's right for your friend might not be right for you. And hormones are not right for everybody. We have clear indications from the FDA about who should be taking hormone therapy. That is for the treatment of severe and bothersome hot flashes and night sweats, which maybe 75% of menopausal women will experience. So many people have that criteria. And also for protection of bones, prevention of osteoporosis. The other things, and there are many other symptoms that women going through menopause experience, are not necessarily reasons the FDA approves for the use of hormone therapy.
So, we've had so many conversations around here at Bloomberg about just women and health and not being, being under-researched and just not getting as much time and attention. I think what's really important, and we talk about health in the workplace, and let's just focus on women, that whether it's menstruating or menopause, like these are things that can impact women in the workforce, and it's not always understood or respected. And so what do we need to understand, especially when there is somebody, let's go, since we're talking about menopause, when a woman is going through menopause, what we need to understand that transition, first of all, why it's important for women to pay attention and the medical profession to pay attention, because it really plays into their longer term health. And then what do we need to have as an understanding in the workplace?
Those are great questions. I think the menopause transition is a critical time in a woman's life for many reasons. It is what we do during this time in our life can set us up well to live long, healthful lives, right? So there are studies that show that severe hot flashes can actually be a risk factor for developing heart disease. So they're not so benign, and they should be treated. And as far as what goes on in the workplace, some people might have changes in their menstruation, right? So they might have heavy menstrual flow and need time to take care of that. They might have symptoms that are bothersome, and they might not be able to sit at their desk for as long. And I do think that educating people and the workplace about what women are going through during this time is what's critical to helping women be more productive. And that study you cited is such an important study.
We talk a lot about the supply and demand challenge when it comes to demand for healthcare and the supply that doctors actually provide. And I'm wondering, from a training perspective, as more and more attention gets focused on different parts of our lives and different parts of people we love lives, like where that comes into training the next generation of doctors, and if we will start to see, because we talk a lot about the gap between women's healthcare and men's healthcare, will we start to see that gap shrink as a result of more people being trained, more awareness about this, and more doctors coming into the field? You're kind of shaking your head.
We are working on that, but we've got a long way to go. I mean, not very recently, studies of OBGYN residents, that's not residents in all the fields, but OBGYN residents who do this, less than 20% feel like they have received adequate menopause training. And only about a third of the residency programs have an actual menopause curriculum. So we're working on that. Remember, up to about 40% of a woman's life is spent in menopause. So many of our healthcare resources in women's health go to the reproductive years. But our goal is to really make sure this time in women's life is addressed.
How does it compare with kind of time and attention spent on aging overall for individuals? And I guess I'm almost trying to make a men-women comparison, but, aging, is that focused on?
I think
generally
it's starting to become trendy, but not as much as it should be. I think the longevity term you hear a lot about right now, but I don't think there's a lot of research being done in it. We're getting there too.
Yeah, it's kind of fascinating. What should an individual, a woman, be asking themselves right now? Just got about 20 seconds about when they're thinking about what you were talking about and what they should be asking of their health professionals.
I think women should be comfortable discussing all of their symptoms, some of which are uncomfortable to discuss with their providers, and they should be finding a provider with whom they can speak comfortably, openly, and who has evidence-based care that they're delivering.
Always important. Thank you so much, Dr. Susan Loeb-Zeitlin. She is the founder and director of the Weill Cornell Women's Midlife Center, joining us right here in our studio. All right, we're coming back. We're taking a look at the markets and stocks on the move.